Before any strategy makes sense, you need the vocabulary. This episode is your reference. Bookmark it, you'll come back to it. Every term I use across the next 28 episodes is in this video. I'll explain each one plainly, show you what it looks like on the chart, and tell you why it matters for the methodology. Market structure is just the pattern of highs and lows that price creates as it moves. A higher high followed by a higher low, followed by another higher high, that's an uptrend. That's bullish market structure. As you can see here, we've got higher highs going through the top, we've got higher lows going through the bottom. Higher high to higher low, higher high to higher low, higher high to higher low is bullish market structure. That is an uptrend. A lower low followed by a lower high, that's a downtrend, bearish market structure. So you can see here we have a lower low, a lower high, a lower low, a lower high, a lower low, a lower high, a lower low. That there is a downward trend, and that is bearish market structure. Why does this matter? Because the strategies in this course are built around structure. Before I enter any trade, I want to know what structure says about the direction. If we're in a bearish structure, then I only want to sell. If we're in a bullish structure, I only want to buy. Break of structure. A break of structure, or BOS, is when price breaks a previous low or high. So right here we've got a bearish example of that. So we've got our lower highs going through the top and our lower lows coming through the bottom. So it's on the lows that as soon as price breaks through that, that is what we call a break of structure. It's a continuation pattern, right? We pull down, we put in a low, we pull back, put in a lower high, and it's when this leg here breaks through that previous low, we have break of structure. Okay, and this is what happens in a trending market. We'll just continually keep going down, and there's specific points throughout these drops where you can use this as an entry model, and that's exactly what it is. It's a continuation entry model. So you'll use this as when you've got a downward trend or an upward trend, and you can get a really tight stop, and you can get a really good risk to reward from that. So when price, as I said, in a downtrend, breaks the lows, the previous low to the downside, that is what we call a break of structure. Again, there's a low, we come down, we break through that break of structure. The low, we come down, we break through that area. That is the break of structure. The fair value gap, you hear so much about it, but there's a couple of important things that you need to know. Number one, this is not ICT's pattern. This has been around for 15 years plus. Traders used to just call them gaps. He's relabeled it, remarketed it. It's called a fair value gap in the modern age. It consists of 3 candles, 1, 2, and 3. The wick high of candle 1 and the wick low of candle 3 is what causes the gap. It's the gap between these 2 wicks. And that's emphasized by candle 2, which creates the gap, right? It's a large price movement through, and then this next candle pulls down, but does not cover the distance between itself, candle 3, and the wick of candle 1. And that's what creates a fair value gap. And as you can see, price pulls into this particular fair value gap, rejects, and then heads to the upside. This is an entry model. It's not a strategy. You need a strategy, and then you need to find an entry model that works with your strategy. Liquidity. Liquidity is one of the most important concepts in this course, and one of the least understood by beginners. Liquidity is resting orders, specifically stop losses and passive orders, waiting to be triggered in the markets at obvious levels. When retail traders put their stops just below a swing low or just above a swing high, those stops become liquidity targets. So I'll just quickly show you how we use it. We use the London session to frame the Asian session. Asian session puts in a high, it puts in a low. It's when London manipulates to the upside and sweeps out all of that Asian liquidity sitting at the top. Now, if we look left, we can also see we've got liquidity from New York PM highs, and we've also got this liquidity sitting here. Now, if you look, we've taken that out with this one move, and then we absolutely melt to the downside. Our target is Asian lows as usual, but I'm going to go through this in more depth later on in the course. This is a strategy that we use in the Discord, and this trade plays out maybe 2 to 3 times a week. You'll hear about liquidity in this course a lot. This is not a conspiracy theory. This is how markets work. Understanding it is what makes liquidity sweeping strategies possible and very successful. Premium and discount are referred to in this course when referring to parallel channels. The lower 50% of any range is a discount zone. If the overall bias is bullish, you want to be buying in the discount, not in the premium. The upper 50% is premium. In a bullish environment, premium is where you look to sell, not buy. Most retail traders do this backwards. They see price going up and they buy at a premium. Then they get stopped out once price pulls back to the discount, which is exactly where professionals were looking to buy. I'll use these terms pretty much in every episode, so it's a really good thing to know. On my screen right now, I've got an upward channel, an upward trend. The parallel channel is running to the upside. We've got our premium located at the top of the 50% of that channel, and below that 50% down is what we call the discount. It's along the discount where we look to buy. When we get up into the premium, we look to sell. We don't look to sell from the top of the premium down. We look to buy from the discount up. In a bearish scenario, the parallel channel works in reverse. The top of the 50%, so that's the 50% line, the dotted line, from there upwards is what we call the discount. From there downwards is what we call the premium. So again, when price, cycles up to the discount, we look to go short down into the premium. It's a very, very easy concept. It's a very easy rule to adhere to, and it increases your profitability tenfold. Session terminology. NQ futures trade almost 24 hours a day, but not all hours are equal. Here's what matters. Asian session, roughly 8 p.m. to midnight ET. London is asleep, volume is low, and a range forms. I call this Asian session range. It's important. As you can see here, it's a pretty low volume area, usually the Asian. Asian actually frames the London, and we get some really good trades off of that. The London session, midnight to 5 a.m. Eastern ET rather. The European market opens, volume picks up. This is where most of my liquidity sweeps occur. So again, as I just mentioned, we take a lot of liquidity sweeps on the London session by framing the previous Asian session. And you can see we've expanded quite a bit compared to the previous session. This is also where I look for dark night setups. Really good session for that. I use the ICT kill zones and pivot points on my charts. It's an indicator that plots all of this out. It's by TFO. It just saves you drawing in the lines, and it pretty much highlights the kill zones, which is what we like to trade. Every term in this course comes from one of those 4 categories: structure, liquidity, location, or session. If you hear something in a later episode you don't recognize, come back here and rerun this video. Episode 3 is a trading view setup. I'll show you exactly how to build the chart layout I use for every session from scratch. Just to close out this episode, one thing that you can really do to accelerate your growth is become part of the free Discord. The link is in bio. In that Discord, I post up my trade setups, my trade ideas, There's a lot of market analysis that goes on within that trade. You get to see what the other traders are trading. You get to see all of this stuff played out in a live environment. It's going to be really beneficial to your growth. So jump in there, say hi when you get there, and ask any question you want. It's my belief that education should be free. There's a bunch of charlatans on the internet. They're going to charge you for courses. I'm not about that. I've made my money. I don't need yours. Jump in there, take advantage of my 15 years worth of market knowledge, and benefit you and your family while you go through this process. Ciao.